All right. Time for more Secret Wars. Stan, you're making me work. All right. I had a few questions last time I came out. I was asking myself, when I move my sell stops, before I move my sell stops up, do I have to wait for the after the pullback? Do I have to wait? When do I have to wait before I move my sell stop? Do I have to reach or surpass the previous highs? Do I have to just start moving upwards like just a green candle and that's enough? So I went back to Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. And there's two phrases that caught my attention. One of them says, not until well off correction. All right. So what does that mean? Well, I guess not until you're well off the correction. But then after that gives more clues. And another phrase says, and until it gets close to prior peaks. So after that, I looked at a few of the graphs he did. And let's say, I'm looking at this graph. Okay, let's say I'm here. I bought in here, went up high, 7% pullback, 7% pullback, and here. So like 3/4 of the way is probably enough for me to move my sell stop. 7%, 7%. It didn't move high enough, so I didn't move it up. It has to be well off. So you have that 7% correction, and you also have to make sure that the V is really looks like a V. If it looks like it, just like maybe a little hockey stick or a sideways L, not good enough. So as a guideline, I'm going to use the 3/4 rule. If I have a V and I surpass the halfway mark and I approach 3/4 of the direction, or at least 2/3, then I'll move my sell stop. What are your guidelines, guys? What have you been dabbling with? Is there some text out of the book, a key phrase that explains this in Stan Weinstein's book that I missed out? Let me know. That was one of the part of the final questions. I tried to reread. I had a second question concerning trend lines, and it says the more valid it is, the more points, the better it is. So 3 points minimum, and breaks on the fourth point. But you need 3 prior points minimum on it. Then if you have 4 or 5, and then it breaks out of the trend line on those subsequent points, the stronger it is, the trend line, the more reason to bail out half of your position when you reach it. So those are the things I read up, and which are giving me some insight on the framework, how it should work. So right now, what I have is Blackberry. Yay! People love Blackberry. 5 years, weekly candle, volume indicator, RSI. What else do I need? 30-week SMA, and my zigzag lines, which Stan, I don't know, he had back in the days, but I'm using that. I set it, my zigzag, at 7%. So every time there's a 7% correction or correction, then I have that little yellow line telling me that that's what happens. So that's what we use for traders moving their sell stops. Any correction under 7%, forget about it. It's not a subsequent enough correction, and you don't want to move your sell stop, you'll just get whipsawed. What's up with Blackberry? All right, let's get down to business. All right, we had a stage 4 back in July 2013. Stage 1, breakout. Stage 2, see this candle right here, and you see the volume right here, and the RSI right here. The RSI going upwards through the 50 line. This is like a perfect stand play. Let's do it. Look, I know the episodes are getting longer, podcasts longer, but it's worth it, man, to practice. So when we start getting some actual candidates. Once we're in, we won't panic with the emotional landmines. So it's like a professional boxer. He practices, spars. It's like our sparring. And when we get to the actual fight, then we could ride on instinct when we could ride on our programmed skills when we start getting emotional. Greed, what's the future? We'll just come back to what we've practiced, how the framework should be. So back in the days here, I had a breakout candle above resistance at the 9 area, support at the, that's a nice tight 780. 30-week moving average flat going up, breakout above. This is a perfect triple confirmation. Breakout above resistance line, more than ample volume, and our side going forward. All right, we'll keep practicing the trader's way and the investor's way until so you guys get to see what it is, and I'll get to choose which one I prefer. Entry, top of candle, 1050, sell stop for investors under the bottom of the formation and under a round number if possible. Round numbers under 20 or 1950, 1850, those half points. And above 20 is 20, 21, 22. Round numbers are there. That's how Stan describes those. Trader's way, you could put your sell stop 4 to 6% under the breakout line. So if the breakout line, this is where you have to get out your calculator. If the breakout line's at $9, 5% is $4.50. 45 cents, sorry. So that 45 cents, $8.50 would be your sell stop. And it just happens that the bottom of this candle is at 8.30, 8.40. So right under that round number, that 8.50, perfect place for, so size accordingly. This should equal size for this value to equal 1% of your NAV, and you're set to go. All right, let's go. Add some candles. Goes up, 7%. Pull back, but wait, we have to wait for the price to get up, and didn't go up yet, so we didn't move our sell stop. We're still in. We want the price want it to go back to previous highs. So pull back here. We're still waiting for it to go higher. Back to previous highs. And okay, here. Yeah, that's back to previous highs, or at least 3/4. So we could move our sell stop right here for the traders and for the investors also, since it's below the 30-week SMA. That's both of their sell stops will be there. And what's the low here? Just trying to make sure I didn't get triggered out. Low 950, low 974. Okay, so we're still in. And go up, correction. Okay, price went back up, so now move our sell stop right here, 974, just a few points higher. And notice now the risk has diminished a lot, right? Your 1% risk was here, and now it's probably only 0.5%. And for the investors, it's maybe 1/3%. So that's what's fun about Stan. You always have a high probability of being in the green. Pull back, but didn't go back up to the high. So we're not gonna bring our sell stop here. Pull back, and we're going up to almost previous highs. Yeah, 3/4. Let's move it up. We go up, pull back, up to previous highs. Move the sell stop. Pull back, move up to previous highs. Trader's way. Under the pullback, investors way under the SMA. So right now I moved up a few candles too many for Blackberry right there. So traders would have been triggered out right here, and investors, they're still in the game, and investors would have been triggered out with this candle here. So did you make profits? Yeah. Traders, you would have made the through the arrow. See, it wasn't a super aggressive stage shoe, but it's still not bad. Traders, here's your profit. It's about almost 1% of your NAV in profits. So you risk 1 and you made maybe 0.9% of your NAV. And the investors, here we go, got in, didn't make as much. Right there, we'll put it a little higher. There you go. So that's a profit. It's nice. You still made profit, and now you want to get out because the moving average is starting to go. It's not going as high, as aggressive as you want it to, and this could be the beginning of a stage 3 right there. So you're out, and then I'll have to do now. You see there's some resistance here, and you have to see either you're going to go into stage 4 or maybe this is a continuation for a stage 2. And time moves on. I see. So it would have continued here. The triple confirmation for breakdowns, there's no volume. Fear is the volume. So it kind of gets trickier. So you have one less trick up your sleeve to one less confirmation indicator for the system, but you have to gauge fear, and fear is when the moving average starts going down, then it really gets bad really fast. So you would have probably entered here if you would have maybe this was a launching pattern, and you would have played down here, pull back, move towards the target. Traders, here, investors sell stop here. Which was my breakdown candle? Breakdown candle is probably this one here. Sell stop for traders here. For investors, the initial sell stop would have been right above here. Price goes down, pull back, goes back towards and surpasses. Traders sell stop moves here. Investors sell stop moves here. And right now investors are they could still get triggered out to lose, but investors could still lose because you entered here, but traders are already in the green. Pull back. All right, traders are out. So traders are out right here. And yeah, for a small profit, probably 1% of your NAV. This was your initial risk. And this is the reward. So it was 1%. So 1% of your NAV risked to win 1%, and the traders, they got it. So traders are out. Investors are still in. Pull back. Price action going towards, but we're not close enough. We're not at the let's say we'll call it the 3/4 rule. We're not even there. Let's add some candles. And no, we're triggered out. We never made it. So investors would have been in for a loss. Am I missing something? If there's an aggressive trend line, then you have to respect it. Is there a trend line where we have 3 points? And I don't think so. 1, 2, 1, 2. No, see, it breaks on the second one. So in this case, investors would have you would have lost 1% of your NAV. You would have got triggered out on this candle right here, or just a little bit less because you move your sell stop at this point. So you would have lost maybe 0.8% of your NAV. The traders always seem to have a higher probability for now of reaching, of being in the green. But maybe it's just my sampling is too low. That's why I need to see other people playing with Stan, how they've adapted and how they've managed to increase their probabilities of staying in the green and riding out the stage 2 without getting whipsawed. Because that's the thing, if you always move your sell stops too tight because you want to be in the green too fast, you don't let enough wiggle room, then you might get triggered out with a small gain, but you might miss the bigger move. So that's the way I see the system works. There are the intricacies of playing the trader versus the investor. All right, let's go see to today. I want to see what's happening today. All right, so now we're at stage 4. We went back up. So now stage after stage 1 is after stage 4, stage 1. Stage 1 could continue in stage 4 or it could go in stage 2. In this case, it decided to go into stage 4, stage 1 to stage 4, go down. And we're still in, okay, now we're back into a stage 1. Okay, there we go. Bam. Oh, that's impressive. Yeah, there's one thing I should always look out is, there you go. There's the breakout candle, the volume. Right there. Tight formation, very nice. 30-week moving average. Okay, breakout above the 30-week moving average. Check. Above the resistance. Huge volume compared to what we've had recently, and the RSI is going up. So that looks pretty sweet. I'm in. A++, stand play. We're in at the 1028. Investors sell stop right under here, and traders sell stop maybe 50 at 950. And if you want just a round number under 945, something of the sort, you could go there. And that's how the traders go. All right, goes up. Oh, that's already 7%. 11. Pull back. Yeah, to 10. So here, already here, traders, we move the sell stop right under that 7% pullback since it went back up. And investors right under the 30-week moving average. And now it seems to want to go up. The zigzags are kind of telling us what's going to happen. All right, what happened here? Okay. We had to pull back, 7%. Price action. What's the next candle? Went up, but didn't close up. So I could still consider that the high. Pull back. Is it going back up? And is it going back up to previous highs? There it is. Okay, that's a 3/4. I think that's at least 3/4 of the way. The investors would have put their sell stop here. And I believe Stan says the traders should never stick around if the 30-week moving average is violated. So the traders, man, there's a lot of stuff in here. So the traders would have bailed out here. So that's another thing you have to keep an eye on is the evolution of the 30-week moving average and have As soon as you touch the 30-week moving average, the trader is out of there. So I don't know right here. I think the trader would have been out before. I might have done it wrong here. If the 30-week moving average is violated, you're out. Trader profit from here to here. And investors are still in. Sell stop for the investors right here. We moved it up here. And now right here. Sorry, here. First sell stop. And then here's the second one. So investors are still in the game. Pull back. Okay, pull back. Price action goes. Yeah, it seems to be 3/4 of the way. So that's. I want to know if people really wait for it to go back up or just happen here 3/4 of the way. Do I move my sell stop here? Then it pull back. And what's that candle? 1286. 1293. Wow, tight. Then pull back, then go up higher. So move it just a little bit higher. Went up, pull back 7%. And yeah, goes above. Sell stop. And here's where it gets tough because the investors' way of putting moving the sell stops under the 30-week moving average. When the 30-week moving average starts flattening out, so you have to try to figure out how to properly identify that. They start using the trader's sell stop. That means if I would say I'm starting to get flattened out, I'm close to the 30-week moving average, my sell stops, I would have put it the trader's way to start getting more aggressive, to start thinking about bailing out. Right now, would I have done that? In the heat of the action, it depends, I guess, if I was greedy, if I was fearful. It depends at that moment how I felt. And I don't like that too much. A lot of emotional landmines. You got to really be really skilled with the framework and really know exactly what to do with many different situations that arise. Pull back. Price goes... okay, so it's working its way up. What's the low of this candle? 1403. I would have put in this the low. 14. So would have came in like 3 cents from getting triggered out if we would have set it right under here as the traders to be like more severe. And right now, if this starts moving maybe a more candle up, then we'd probably move the sell stop the trader's way right here. Or if somebody's going to tell me, hey, Pat, no, this is not traders. You're still, it's still going up fairly good, the 30-week moving average, put it the investor's way, then I would have put it down here and it'd still be in the trade. So there's a lot of landmines, man. I have to take that on to consideration. And I think I'll have to reread a little bit about reread those chapters. Wow. Okay. That's for Blackberry now. So what I can tell you about now, Blackberry is in a stage 2 because I'm still in the trade. If I would have entered here on this nice breakout back in, what's that candle there? March. Last week of March when we had that super duper nice breakout, I'd still be in. So now what we could see though, do I have 1, 2, 1, 2, 3. Oh, okay. Now we have a nice trend line, guys. So that means if we have a 3-point trend line, 1, 2, 3. This applies for traders and investors. You put your sell stop. You follow the price action, and you every week you move your sell stop on that line. So this week put the sell stop here, next week put the sell stop here for half of your position, and you continue after that putting your sell stops as a trader or as an investor. So right now I would probably have my position here, and I would do my sell stops the trader's way, even if I start an investor. Because if I'm about to exit to bail out because of this nice trend line, then I want to bail out also for the I believe that the stage 2 is ending, and I want to bail out also there. Okay, that's my reasoning for now. I'm known to change my mind. I don't mind if there's new information that comes to arise. I will change my mind. So Stan really does mention trend lines, and I think you can't overlook that. It's an important tool in your arsenal, and I see now why. After time that forms, this is going to give us a chance to exit at the highest price possible, and not wait until the price action goes down and reaches our further away sell stops under a 30-week moving average. Because the furthest away target is the 30-week moving average. That's like almost the worst case scenario for a trader. Investor could be a little lower, but usually that's the lowest. But if you want to maximize profits, you got to use those trend lines and the swing rules. If ever we see a pattern here forming, I don't know, let's say a head and shoulders pattern that would form, then the measure move from that, we'd take probably half our position when we reach that target and ride the other half with the traditional exit strategies. All right, stage 2 for BB. It still seems pretty bullish for me. If anybody is still in there, then you could continue doing the Stan's way. And right now, I don't have an entry to go this deep into the stage 2. So, but the stage 2 could keep going a lot higher. I have no idea where it's going to go. But until I get triggered out here, it's still stage 2. If ever I keep playing it, even if I'm not in, but just playing it to keep practicing, and I get triggered out, then that's a sign that I'm reaching my entering a stage 3, which could either become a stage 4, a down cycle, or could also recontinue as a stage 2. Wow. Okay, man, that was intense. Try to absorb all that. Replay this video a few times like I usually do, and see I could make it better, man. It's always about refining the process and practicing. All right, happy to share this with you guys, and don't hesitate to beat me if you have anything, any charts you want me to check out using Stan's system, or you think that's going to break out soon, and then maybe I could purchase and enter. All right, ciao.